Hi, I'm Peter Rose, founder of Longwood Currency Trading. Forex trade entry conditions is the topic I want to chat with you today. It's a bright, sunny, late February 2026 day. We had a snowstorm the other day. We got another, 8 inches, I think, something like that. So I was out yesterday shoveling, and so today, got to get this video done. We just had some economic releases, indicator today. Prices just all over the place. I knew that was coming, so I'm not even looking at the trading platform. I don't want to be talked into it. I don't want to have to worry about making decisions about trade entry analysis based on erratic price movement due to what would appear to be conflicting economic indicator information that's been coming out over the last couple of weeks. Interest rate, housing starts, employment numbers, the JOLTS, and unemployment are the big dogs right now. And the inflation rate, interest rate. What's the next Fed decision going to be? Let's just stand on the sidelines. I'm recording this on a Friday, so you usually want to be very careful on a Friday about how you're evaluating the possibility that you have a good entry in front of you. You have to remember that the market's going to close at 5 o'clock on Friday. Well, whatever time it is. I'm East Coast US, so 5 o'clock, we close it out. And knowing that, the brokers are not, the big institutional traders and brokers are not instituting a lot of action in a $7.6 trillion a day market. You're solidifying your positions for over the weekend, rather than going, oh, I'm going to take a $400 million flyer here and do these currency transactions now, get my client XYZ, because that could turn around and bite you as a broker, trader on the floor of the broker. So why do that? Because of the increased price. I mean, when I was starting looking at the Forex market in 2007, it was $3.4 trillion, and the retail market was about 15% of that. Today, it's $7.6 trillion. The retail market is probably only about 5%, but that's still a shithouse full of money. And you could get the retail traders now to push the market around where back before, even though they were 15% of the market, they weren't pushing much around. They were just the real tail. So who are the retail traders? Us. Who are we trading against? We're trading against other retail traders. And because 90% of the traders get it wrong, retail traders get it wrong, if you're following standard, whatever it is that you're learning out there, trading process, you're following the herd, right? You're trying to see where everybody's going, moving averages and Bollinger Bands and all that other shit. Whose activity are you measuring? Are you measuring people that know what they're doing? No. So how do you beat that? Well, the key is, first of all, you don't beat it. When you know that there's economic indicator releases that are coming out and it's Friday, you don't trade it. But other than that, if there's no major release numbers coming out for one of the two pair countries, or both, I'll trade it. And you're not looking to make 30 or 40 pips. You're not looking for the price action to establish any kind of big trend following stuff. I mean, it's almost a parabolic, decay of pricing through the whole day. People are going home. They're shutting things down. They're not thinking about putting big trades in line. They're thinking about what they're going to have to meet up with the guys after the market closes. the psychology of the market affects not only us as retail traders, but also those institutional traders who are dealing with the psychology of the other people that they're dealing with. We're all humans, right? You have to have humans behind this stuff. You can't have AI running things because they don't have the same thought process of need and forward thinking and all that other sort of stuff, because it's so erratic. You could have a storm that knocks down the wheat crop that affects manufacturing somewhere. You don't know how all these people that are out there are going to interpret the news, because bad news in some situations is good news for other people. When we're looking at our entry phase, and that is a phase, and I define it in what I call my life cycle of a currency position, which is a rip against my 33-year career as a software engineer, where we used the software development life cycle, the SDLC, to solve these really complex business applications, accounting, warehousing, money flow type business programmatic solutions that we were solving, that we were using to solve these problems. So the entry is the start of anything. You got to get in the car before you can go. You got to get up on the diving board before you can dive. You got to get out your guitar before you can start picking. And so there's stuff that you need to do before you make that trade. The life cycle of a currency position has 3 phases to it: entry analysis, position management, and exit methodology. The entry analysis is the most important. There are a lot of people that say, oh, any dumbass can enter the trade. It's knowing when to get out. Stupid or what? If you don't have a good entry, you do not have a position to manage that's viable, and you don't have anything to get out of. So your entry is your critical thing. It's the critical point of the whole life cycle of a currency position. The other 2 phases are relatively straightforward if the rules for the solution of those other 2 phases, position management, entry analysis, and exit methodology, have their roots of rationality in the entry analysis phase. My phases all have one rule that solves each phase. So as complex as the entry analysis process is, it only has one rule. Now, each rule in the life cycle of a currency position, or any rule to do anything, is condition-based, if it's a good rule. You don't want an analog response to a rule. You don't want to input data into a rule about walk into the store, and the rule goes, well, if it's raining out, then you're going to want to do this and this, and it looks like it might be a little cloudy, so you probably want to wear a hat, and maybe ice will form. Take a pair of ice clogs with you. You don't want a rule like that. You want to have the rule return to you a binary. Yes, you could walk to the store, or no, you probably don't want to walk to the store. So that rule is really difficult to form. So to simplify that, we break it down into conditions. If this is okay, and this is okay, and this is okay, and this is okay, 4 things, then you execute the rule. You get a binary yes. If this is true, and this is true, and this is false, and there's still one more rule left, you get a binary no. That's it. That's how you can set these trading rules that you have up. I mean, if you're using stuff like when there's confluence between the Bollinger Band and the RSI, the stochastic is this, and you've got a Tuesday, and the moving average, the price popped to 55 for the first time in 18 days. That's not process. Those are not conditions. It's just stuff. Now, almost everybody that's out there is doing stuff like that because that's what everybody does. Well, that's why everybody, 90% of the people lose, is because they're doing that stuff. I don't use that stuff in the conditions in my rules because my rules are based on what's called process-oriented trading. It's not based on a system. A system is a golden cross. When the short MA crosses a long MA, do this. Or the London Open, the old London Open thing. Or along engulfing candle patterns or pin bars or whatever. That stuff doesn't work, and I've talked a lot about that. Well, what does work? Having a process. If I'm going to walk to the store, I have to have a process. I don't just walk to the store. I'm going to go out, and it's raining. I put a hat on, I put my coat on, and I walk more carefully so the concrete might be slick. I have a better container to bring the groceries back from the store. It's a process. It isn't put your hat on, walk out, take the bag and go. Because if it's that, you might forget the bag. If the bag is part of the process, then you don't forget it. So when I'm writing my entry conditions, they're sequential in order of importance, and also the thrust of the video is answering a question from a student that I had. How many times do I have to do the entry analysis before I take a trade for the day? Well, if you're doing scalping, then you're using a different rule than the rule for trading. The rules that I use for trading are based on a day trading, or you could use it in swing or even position trading, but not scalping, because scalping is a totally different thing. So it changes everything. You don't have a full life cycle of a currency position because it doesn't last that long. It's like a firefly. It's gone the next day. So when you're looking at day trading, you might make 3 trades during the day. So if you're sitting there at the desk for 4 hours, like so many of these guys that you see that are trading, they've made a lot of money, so they're living on their trading, so they can sit at the desk and trade and talk to you about how great life is. But you work a job, so life isn't going to be that great. That's why when I structured my fast track trading course that I teach, it's geared for the person who works, which is 99.9% of the people that are going to be retail traders. So when we're looking at trading, we're only trading an hour in the morning before we go to work, or maybe 2 hours. Hopefully you'll be able to do it 2 hours, but you could do it in an hour. But you have to be really, really good to do that, because you have to do your analysis to assure yourself that that position is going to run quickly to its terminal point, and then you can get out and you're done for the day, or 2 positions in that 2-hour period of time. When you have that entry analysis conditional based rule, and you're going to be trading, let's say making 3 trades during the 2 hours that you're there, or maybe you get the day off and you're going to trade for 4 hours. Then every time, if the longer period of time that you have, the more likely it is that you're going to be trading throughout that whole period. That being the case, you're going to have to do a full entry analysis each time you go to put a trade on, because a lot can happen in 10 minutes, 15 minutes. So you need to redo that. Remember, all of the analysis that we do is probabilistic based. It's your best guesstimate based on the solution of the rule that you're using, and those conditions form that solution. So if you're spreading the use of that rule out over a long period of time, because of the variance in the price action itself, you're going to have to do a full entry analysis each time you put that position on. When you're looking at going through the full entry analysis rule that has more conditions in it than the other two, because that's got to set the groundwork for the other two rules. So the rules all have between 2 and 4 conditions in them. My particular, the entry rule that I have is 4 conditions. Now, when I have a student, they may be more comfortable with 5 conditions or 8 conditions. It doesn't matter. And the reason it doesn't matter is because they may be setting the groundwork for a different type of trading, a swing, or maybe they're saying, I'm going to go to scalping, so I really need to understand these things. So we build the conditions to suit what you're going to want to do at some time, but it should be usable on a day trading basis. If you learn this stuff on a position trading basis, there's no way you could come back and day trade. Just you wouldn't believe in it. Or a swing trading. If you were in swing trading, it's not. But if you learn how to day trade, the rules, the way that I'll teach them to you, are structured so that you can apply those rules into a swing or a position management trade, long-term position trade. You can use those same rules. You just change a little bit of the input in. Instead of saying, well, I got an ATR of 5 pips on a 5-minute chart, I'm going to go on a position chart and I'm going to look at a daily and I got an ATR of 90 pips. Now everything should adjust, and it should if you write your conditions correctly. But if you're going to be the day trader with the absolute max of 2 hours and you're looking for an hour, hour and a half, then the question is, do you need to do a full entry analysis? Now, let's get this straight from the get-go. The entry analysis process that I teach takes about 15 seconds once you get skillful at it. And you're not skillful at it for maybe 5 months or something like that, but the course lasts 6 weeks, and in that 6-week period of time, you'll understand what I'm talking about. Say, there's no way you could do all that, and these people are doing all this kind of analysis. You don't have to do any analysis in the currency market, and there's reasons for that. And that's why I can turn the trading platform on, pull it up, and I answer 1 or 3 questions right away. That's before my entry analysis. It's the preliminary market conditions analysis. Number 1, is there anything I need to sit down right now? That platform just came up. Is there anything I need to sit down right now and hit bid ask? Number 2, well, things are looking pretty good, and fairly soon there should be something that's going to take place. I'll go off and get a cup of coffee now, or take a dump, or whatever I got to do, and then I'll come back and I'll reevaluate the situation at that time. The third condition is, holy crap, this isn't going to work out. There's economic indicator releases splattered out throughout the day. Here on the East Coast, most of them happen at 8:30 in the morning. Some of them are going to be at 10 o'clock. The other pair of country, because they may be 3 or 4 hours ahead or behind you, their economic indicators are coming out, and you just go, bah, there's just nothing I want to do today. And in that case, you turn the computer off and go to work 2 hours early. However, the entry analysis phase says, I'm sitting here, I'm ready to go, let me look and see if this particular price action that I'm seeing, that I think is viable, let me see if it meets the entry conditions. And I go, and that takes 15 seconds to run through those 4 conditions with absolute certainty that the binary result that I get back, yes or no, is valid in a highly probabilistic sense. That's the key to it. Highly probabilistic. That is a correct result, that rules puke back at you. Now you put that trade on. Remember, we're on an hour and a half time frame, and then you got to get to work. Okay, so you put that position on, and it pukes on you. Okay, great. I go to the next opportunity as I see it. Am I running through the full entry analysis? No, because the early conditions in the analysis set what we call the base line of price action at that time. Price action is moving here, such and such, and blah, 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 blah. And those conditions are always going to come true. It's only the last two conditions where you might get a no. You might get a binary no. It's the last two conditions then that's all you have to do as that price, you got out of that position and blah, 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 blah. Now you've gone 5 or 10 minutes and you're evaluating those last two conditions. It makes it very simple. You just watch the price action and you've got those two conditions in your head. Oh, those are satisfied, bang, and bid ask happens. The problem comes if you try to move down to scalp. Even though it only takes 15 seconds to do the full entry analysis thing, and it's still going to take you 15 minutes, even if the last two conditions, 15 seconds, even if the last two conditions are there, because you're evaluating everything in your head. What's 15 seconds? Well, if you're scalping, 15 seconds could be the difference between a successful day and a bad day. You can use the rule and you can use the conditions, but you can't use all of the conditions. You can only use one of them, and that's the trigger condition. Either and it isn't even entry. It's because you're entering and exiting like that. You could do two trades, two complete trades in 15 seconds. So you really have to have a rule that has one condition to it. So you have to, when you're building that rule, when I help the students build that rule in the Fast Track course, that rule becomes easily compressed down to one condition. That's all you have to do. You're just looking at it and you're making your decision based on that. So Forex trade entry conditions are the actual condition, not the conditions of the market or the Bollinger Band or all that shit that people talk about. The conditions that I'm talking about here, the Forex trade entry conditions, are the conditions in the entry rule, entry analysis rule, consisting of conditions. So you may have 8 conditions, you may have whatever. We have to talk about that. We have to work through that as you go through Fast Track course. Primary sequential order. That's what the conditions that I teach for the rules that I show you how to build in the Fast Track course. If you have questions about any of this stuff, send me an email. I'll be happy to chat with you about it, no charge. I might even be able to offer you some advice to solve some problem that you have, or we could just talk about trading in general. I'd love to chat with you about what your experiences are. And if it turns out that you think I know what I'm talking about and you want to take the Fast Track course, fine, we can talk about that. So if you have questions about any of that, please feel free to throw me an email. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.